When people think about money advice, they often imagine aggressive investing, high returns, side hustles, 10x your income. But financial stability is not built on excitement. It is built on structure. Minimalist money rules are not about deprivation. They are about eliminating financial fragility. Because instability does not usually come from one catastrophic mistake. It comes from too many subscriptions, too much fixed overhead, too much debt, too little liquidity, too much lifestyle inflation. Financial stability is not about being rich, it is about being resilient, and resilience is mathematical. This video is not about becoming wealthy overnight. It is not about speculation. It is not about shortcuts. It is about rules, simple, disciplined rules that reduce risk, reduce stress, and increase long-term optionality. Let's begin. Always spend less than you earn, non-negotiable. This sounds obvious. It is not common. Income does not create stability. Surplus creates stability. Financial stability begins with one formula. Income minus expenses equals surplus. If surplus is zero, you are financially exposed. If surplus is negative, you are deteriorating. If surplus is positive and consistent, you are building stability. Minimalism here means you do not optimize for status, you optimize for margin. Margin is protection. Without margin, any disruption becomes crisis. With margin, disruptions become inconveniences. This rule is foundational. All other rules depend on it. Build a liquid emergency fund before investing aggressively. Minimalist money prioritizes stability before growth. A common evidence-based guideline suggests holding 3 to 6 months of essential living expenses in highly liquid, low-risk accounts. Why? Because unexpected events are statistically normal. Job transitions, medical costs, home repairs, economic downturns. Without liquidity, people often sell investments at market lows, use high-interest debt, make rushed financial decisions. An emergency fund is not an investment strategy, it is a risk management strategy. Liquidity preserves choice. Choice preserves control. Control reduces long-term damage. Eliminate high-interest debt. High-interest consumer debt is mathematically destructive. If a credit card charges 20% interest annually, paying that balance is equivalent to earning a guaranteed 20% return, risk-free, by eliminating it. Historically, long-term diversified equity returns have averaged significantly lower than that over extended periods. This is not anti-investing, it is arithmetic. Minimalist money says, remove financial drag before seeking financial acceleration. Debt that exceeds reasonable expected investment return should be prioritized for elimination. Interest compounds against you just as powerfully as it compounds for you. Keep fixed expenses low. There are two types of expenses: variable expenses, food, entertainment, travel; fixed expenses, rent, mortgage, car payments, insurance, subscriptions. Variable expenses can be adjusted quickly. Fixed expenses lock in obligation. Financial instability often results not from small daily purchases, but from large fixed commitments that reduce flexibility. Minimalist stability means choose housing below your maximum approval, avoid excessive car payments, be cautious about recurring financial commitments. The lower your fixed baseline, the more adaptable you are. Adaptability equals stability. Automate savings. Behavioral finance research consistently shows that humans struggle with delayed gratification. Automation reduces reliance on willpower. If savings and investments are automatically deducted, you remove friction, you reduce decision fatigue, you increase consistency. Consistency outperforms intensity in long-term financial outcomes. Minimalism favors systems over motivation. Diversify, but do not overcomplicate. You do not need dozens of speculative positions. You need exposure to broad asset classes aligned with your time horizon and risk capacity. Diversification reduces concentration risk. It does not eliminate volatility. Minimalist investing principles often include broad-based index exposure, periodic rebalancing, low-cost structures, long time horizon. Complexity does not equal sophistication. Often, complexity increases oversight errors. Simplicity reduces behavioral mistakes. Avoid lifestyle inflation. As income increases, spending often increases automatically. New income becomes new obligation. Minimalist stability requires increasing savings rate as income rises. If your income increases 10% and spending increases 9%, your stability barely improves. If spending increases 2%, surplus expands significantly. Wealth is built in the gap between earnings and lifestyle, not in earnings alone. Protect your income. Your income may be your most valuable financial asset. Without income, savings erode. Investments may be liquidated. Debt becomes harder to service. Minimalist risk management includes health insurance, disability coverage where appropriate, term life insurance if dependents rely on your income. Insurance is not a wealth-building tool. It is a collapse prevention tool. Stability is preserved by reducing catastrophic risk. Avoid speculative mania. Financial history includes repeated cycles: dot-com bubble, housing bubble, cryptocurrency surges, meme stock volatility. Speculative assets may generate extraordinary returns for some participants. They also generate substantial losses for others. Minimalist stability prioritizes long-term compounding over short-term excitement. If you participate in speculation, do so only with capital you can afford to lose without destabilizing your plan. Stability requires boundaries. Know your net worth. What gets measured gets managed. Net worth equals assets minus liabilities. Track it periodically, not daily, not obsessively. Quarterly or semi-annual review is often sufficient. Trends matter more than single snapshots. Net worth reflects structural health. Income reflects activity. Why minimalism works. Minimalism is not about austerity, it is about clarity. It removes noise, unnecessary subscriptions, redundant accounts, excessive consumption, emotional investing. Financial stability is rarely destroyed by lack of knowledge. It is usually destroyed by inconsistency. Minimalist rules reduce decision complexity. Reduced complexity reduces mistakes. Reduced mistakes improve long-term outcomes. Common misunderstanding. Isn't this boring? Yes, stability is boring. Boring is resilient. Exciting is volatile. Financial media often amplifies extreme outcomes, but long-term financial security typically built through moderate returns, high consistency, controlled risk, behavioral discipline. There are no guarantees in markets. There are no guaranteed returns beyond insured instruments. But disciplined structure improves probability, and probability over decades determines outcome ranges. Midpoint summary. Minimalist money rules. Spend less than you earn, maintain liquidity, eliminate high-interest debt, control fixed expenses, automate savings, diversify simply, resist lifestyle inflation, protect income, limit speculation, track net worth. None of these are revolutionary. All of them are effective, if implemented consistently.